Thank you for joining us for a brief update on second quarter 2022 markets and outlook. I'm Marc Balcer, the Director of Investment Strategy here at Girard. We're pleased to share this new look for our quarterly investments currents call that we hope you'll find useful and accessible. In the coming weeks, you'll hear from my colleague Tim Chubb for insights on our market outlook and key themes impacting investments. Reach out to us by visiting www.meetgirard.com to learn more about how we can work together to achieve your financial goals. Let's begin with a review of global markets, which were once again challenged across the board in Q2 2022. Investors entered the quarter with some optimism on the heels of a late March equity recovery, but this optimism quickly vanished. The key drivers boiled down to just three words: inflation, rates, and growth. We entered the quarter with accelerating inflation that failed to peak as quickly as some had hoped. This drove global monetary bodies to raise interest rates more aggressively to combat inflation. Given monetary policy tightens access to capital, we began to see indications of slowing growth and demand as the quarter drew to a close. This led us to an environment where there was almost nowhere to hide, with many asset classes declining even more than they did at the start of the COVID pandemic. Growth stocks were the weakest, with both NASDAQ and the Russell 1000 Growth struggling mightily, while more defensive indices, including the Dow Jones Industrial Average and Russell 1000 Value, dropped significantly but by somewhat less. International stocks, including emerging markets, were down in the mid to low teens, partially attributable to lower valuations and higher energy exposure. While small caps struggled more than large caps, their relative valuation and more limited exposure to a slowing Europe may offer some tailwind into the second half of the year. Fixed income fell on rising rates and credit concerns. It was a punishing quarter for equities, with U.S. stocks in particular taking a hit. The quarter included a 7-week losing streak for the S&P 500, which has brought the price-to-earnings ratio for the index back down to its 25-year average. We have yet to see economically driven cuts to individual company earnings estimates, meaning declines were entirely attributable to lower valuations. This hit growth stocks the hardest, including expensive or unprofitable technology, consumer and communications leaders, as well as companies with durable goods or housing exposure. After the S&P declined nearly 10% in April, markets were choppy but ultimately flattish in May as the tail end of a generally positive earnings season wound down. Once again in June, however, markets moved lower. This late quarter decline was precipitated by warnings from several retailers and concerns about inventory gluts, or at least inventory mismatches between what consumers wanted, necessities, and what was on the shelves, discretionary items like furniture and appliances. As mentioned in the previous slide, there was almost nowhere to hide. Within the S&P 500, energy was the lone standout, rising significantly, while communication services, consumer discretionary, and technology all dropped approximately 30%. We did see some distinction on a style basis as S&P Value outperformed S&P Growth, driven by its energy exposure and underweight to technology and consumer services. Fixed income investments struggled yet again, continuing their worst start to a year in half a century. Deutsche Bank even reported that first-half performance for the 10-year Treasury bond is the worst since 1788. The two drivers of this poor performance were rising rates and credit concerns. It is relatively rare to have both of these challenges rear their ugly head at the same time. Over the course of the year, we've seen the Fed Open Markets Committee move from expecting no more than a percentage point of rate hikes to as much as 3.5 or 4 percentage points before this cycle is over. The chart on the upper right shows the yields on the 2-year and 10-year moving higher while bond prices have moved lower. As the quarter closed, we began to see a drop in these yields, which makes sense given slower economic growth and inflation data points. Markets are suggesting the Fed could see this information as a cue to slow or suspend hikes earlier than planned. On the bottom right, you can see how the quarter also saw a very dramatic widening of yield spreads. Yield spreads are the difference in interest rate between investment-grade bonds and below investment-grade or high-yield bonds. The ICE Bank of America High Yield Index showed this difference rising from 3.4% to 5.9%. In essence, this means that high-yield investors are demanding nearly a 2.5 percentage point higher premium for taking risk than they did back in March. This is good news if you're in the market for high-yield bonds, but not so much if you own them. Despite this move, high-yield credit quality remains strong with limited upcoming maturities, solid balance sheets, and good coverage ratios. It's important to make a distinction between stocks and bonds because bonds generally have a stated value that will be returned at maturity along with recurring interest income payments. One thing we've seen over the past 6 months is that the typical bond, which was trading well above its redemption price, is now trading well below its redemption price, offering additional return potential as the bond approaches maturity. And as these bonds mature, fixed income investors are able to reinvest at these newly higher rates. As we stand in early July, bonds have become more attractive with investment-grade yields approaching 3% and below investment-grade yields in the mid-sixes. The capital appreciation pickup opportunity could add another 1 or maybe 2 percentage points unless we see a significant default cycle, which doesn't appear on the horizon. We'll have more to say about these big drivers I highlighted, inflation, rates, and growth, as we continue our investment current series throughout this month. There's no doubt that intra-quarter spikes in oil and gasoline prices spooked consumers and seems to have dampened spending. As we sit on July 7th, we have fortunately seen a dramatic reversal from its June high on the order of 20% for oil that should slowly find its way into lower gas prices and other components of CPI that have already stabilized outside of food and energy. This chart shows the huge impact that both used car prices and other durable goods inflation has had on CPI and how it's waning, but we're certainly monitoring the impact that a multi-year climb in home prices will have as this increase finds its way into rental rates. It's hard to say what impact this will have, as some rental pricing indicators have softened in early July. We encourage investors to remain broadly diversified with careful planning for short-term goals balanced against goals of long-term investment for the future. We'll be back soon with our quarterly outlook and other investment topics, but in the meantime, feel free to contact one of our advisors by visiting www.meetgirard.com. Thank you for watching.